Well, the Bank of Canada is having a little bit of a crisis right now on how they determine policy rate decisions, how they look at core inflation, and ultimately the transparency and the messaging that they're sending out to Canadians. And ultimately, with all these particular changes, all these things that are geared up for 2026 for the Bank of Canada, their changes to the way that they look at things, that framework, I want to take an opportunity and break it down how this is going to impact Canadians with their mortgages and what they should be looking for, what they can be looking for come 2026. Once again, thanks for stopping by. If you have not yet subscribed to the channel, please consider subscribing, hit that notification bell, leave your thoughts, questions, and concerns in the comment section below. Like and share the video if you know someone that could benefit from this content. But now let's get right into it. So ultimately, right now, as we've discussed, the Bank of Canada is facing an identity crisis on the way it approaches inflation and monetary policy. So what does all this mean? Let's break it down very simply. For the longest time, the Bank of Canada was sort of beating around the bush with the way it looks at particular metrics within inflation. Ultimately, it looks at medium, trim, common, those core measures of inflation that strip out volatile things like food and energy in most cases. And ultimately, right now, the Bank of Canada is saying that while that data can emphasize and de-emphasize certain components in the Canadian economy, it's not necessarily true to form in the way that we should be approaching inflation when it comes to making those decisions. And ultimately, a lot of convoluted messaging from the Bank of Canada, no direct, clear path on what the Bank of Canada is doing. We've talked about on the channel before, the forward guidance that the Bank of Canada has laid out to millions of Canadians is not clear. In most cases, we would have to watch those press conferences, try to dissect what the governor and the governing council were trying to say on the direction of where the Bank of Canada is going. And ultimately, this really pales in comparison to what we see happening in the US. So ultimately, in a nutshell, in 2026, there's going to be some massive reforms or hopefully some changes on the way it looks at these data points. And ultimately, without getting into too much details, what they're going to be doing is looking at basically implementing AI and other tools that are going to be able to sort of give them a little bit more up-to-date data. Keep in mind, right, the Bank of Canada for the longest time was using, in my opinion, antiquated data. They're looking at backwards looking indicators, not forward looking indicators. And unlike the US that look at things like production and where things are going in and around the consumer and where businesses are spending, they're looking at all these different components to get an idea of where the Canadian economy is going, ultimately where the market was going, right? This is something that's completely different. And the Bank of Canada, I don't believe, was deploying those tools accurately. So what this all means is the way that the Bank of Canada was doing things in the past is not the way they're going to be doing things in the future. And basically, they're going to be looking at multivariate core inflation or MCT data, which is a method to sort of, emphasize and de-emphasize certain things. Now, as they sort of make these changes, we'll obviously be keeping you up to date with these particular changes. And it's important to understand that you're subscribed to the channel so you can stay up to date with that stuff. But more importantly, I mean, just to sort of bring this closer to home, especially for Canadians and mortgages, because that's what we focus in here on the channel, is literally how over the last little while, if you may recall, when interest rates were on the rise, the mortgage inflation or those mortgage interest costs that were basically added into the mix were sort of keeping the Bank of Canada at bay from cutting those rates. I mean, you have this sort of self-fulfilling prophecy, interest rates go up, more Canadians are paying more money to cover their mortgage and all the things to service their mortgage needs and lines of credits. And that was driving inflation higher. And that means the Bank of Canada was continuing to hike. I mean, ultimately, they want to remove the mortgage interest cost from the actual measures that they use when determining inflation. Now, I believe the US uses rent, not mortgages, which may or may not be a better strategy. I think this requires a little bit more conversation and more or less more data. But ultimately, I like the fact that they're going to be able to remove certain things and change the components within these buckets. Now, with that comes problems because you can manipulate that data the way the Bank of Canada sees fit, right? So ultimately, if you include and exclude certain components, sure, you can get that inflation to come in lower. I mean, the Bank of Canada has been saying that they're thinking they're around 2.5% inflation. That's where they think that they're resting at. And ultimately, if you ask day-to-day Canadians who are going out to the grocery store and spending in the economy, they definitely feel that inflation is much higher than that. So that's up for another debate. But at the end of the day, we can potentially see more clarity, more transparency from the Bank of Canada moving forward in 2026. Now, ultimately, what does this mean for Canadians? Ultimately, I think what this could mean for Canadians is, hey, we're going to have a better picture or maybe a very clear understanding of where the Bank of Canada is going to be headed, as opposed to guessing, hey, are we going to be cutting rates? Are we going to be hiking rates? So that we can actually prepare the Canadian consumer and the economy. Because the Bank of Canada, super important to understand that the Bank of Canada wants this inflation to be at 2%, bandwidth between that 1 to 3%. We've talked about it at great nauseum for the last little while here on the channel. But at the end of the day, the Bank of Canada is now going to provide us with a little bit more of a systematic approach, or at least that's what we think is going to happen. And with that, many Canadians are going to be able to make future decisions and planning more accurately, which means, do I take a fixed rate mortgage? Do I take a variable rate mortgage? Do I look at the components like we talked about last week of a hybrid mortgage? Are we going to see an economy where Canadians are seeing these interest rates drop and in turn spurs more consumer sentiment or positive sentiment to go out there and spend as our household budgets and household spending is slightly increasing as interest rates have started to decrease a little bit. Now, consumers are very sensitive to interest rates. And if we can get a little bit more guidance on where the Bank of Canada is headed, because let's put it this way, most Canadians, when we're talking to them about their mortgage, their renewals, what they plan to do with their mortgage, I plan on buying, the question is should I go fixed? Should I go variable? A lot of Canadians have already predetermined what they're going to be doing, but that's because of the lack of clarity from the Bank of Canada. So we saw this case in point, sort of just to bring it back to when the governor of the Bank of Canada said, hey, we're going to keep interest rates lower for longer and all this yada, yada, yada stuff that we've talked about at great length 5 years ago. But ultimately, that was a misstep. And the Bank of Canada is still playing the crisis of building credibility with Canadians. And because of those mistakes, they want to increase their credibility with Canadians by providing a little bit more clarity. And I think at the end of the day, whether you agree or disagree, I think this change to the framework by the Bank of Canada in 2026 will allow Canadians to make a better decision. Now, once again, as I said, Bank of Canada not necessarily focused in on housing. Housing is, I believe, a byproduct of lower, higher interest rates, affordability, and consumer sentiment. The Bank of Canada doesn't generally just determine, hey, we're going to turn on the taps. Remember, the Bank of Canada monetary policy is a blanket, it's a hammer, it's a blunt instrument. It's fiscal government spending that is more precise versus monetary policy. So monetary policy can lower interest rates, make things more affordable by lowering the cost it takes Canadians to borrow. A lot of Canadians don't necessarily have the cash. They have the means. They have the lines of credits, they have the credit cards to go out there and purchase. And I think that's sort of on the agenda for the Bank of Canada right now, is ultimately provide more clarity, rebound the economy, and we'll see in 2026 if the Bank of Canada and its policy framework will actually include a true dual mandate, which is inflation and employment. That is yet to come. But I believe the Bank of Canada is going to gear up or tee up for another rate cut. So with that being said, ultimately, the next Bank of Canada meeting is on October 29th. Do you think the Bank of Canada is going to be cutting? How much do you think they're going to cut by? What do you think is going to be happening over the next little while? What are your thoughts on the framework changes by the Bank of Canada? Let us know in the comment section below. Don't forget to subscribe. But until next week, thanks again for stopping by, and we'll see you all next week.